Hey guys, this is Vic from Grasping the Market and welcome to our market briefing. Today we have change on the larger time frame as we made new monthly highs getting closer to the all-time highs recorded last month. On the weekly, we now have been one time frame higher for 3 weeks in a row. After today, we extended above the previous week high. On the daily, we see a clear break from the short-term balance range that we had last week with an opening gap holding through the session. As mentioned in yesterday's briefing, the chances of breaking away ahead of the FOMC were slim, except in the presence of a relevant headline or something changing in the market, and that's exactly what happened. This time on the trade front, we had optimistic headlines from the president himself, and that was enough to trigger a break and a push higher. Now, despite the lower excess that we have in place and the gap holding, we still see short-term money driving the show, judging by some mechanically traded reference like the top has a very questionable excess and the afternoon pullback coming exactly to the early morning pullback. And also you see no excess at the high of that late afternoon range. So we still see, it is expected because being so close to the FOMC, probably large portfolios and institutional money has already done the required adjustments and they're waiting on the sidelines before committing, waiting for the FOMC to say what they have to say. So having said that, the immediate focus is on assessing continuation from that break we saw from balance, with acceptance below the afternoon pullback, which is a week low, will denote change and it will bring into play the former range high at 29.1575. This is a key area because if we start getting acceptance below that level, that could confirm a failed break, and that will be a re-entry of the range, and that's a dangerous situation. On the other hand, if we get acceptance above the K high, which is at 29.2875, that increases the odds for continuation given the relatively small upper excess that we have in place. I think that the market is likely to be tight ahead of the FOMC, as people wait in the sidelines, limiting risk. And remember, we continue to carry forward the weak lower structure of the former range. So in case that we have a shock by the FOMC and the market takes it negatively and we start getting acceptance back into the range and we fail, there is the potential. It's not uncommon when you have a range and you attempt to break and the break fails. It's not uncommon to see the market going to the opposite side of that range. If this happens here, remember that all these poor lows create a very vulnerable structure, so it could be the case that you break through all of them at one single time and you go outside the range to the downside. But again, that's getting ahead of the events. Anything can happen because odds are just odds, and it's gonna be a very volatile session after the FOMC. So keep your risk tight and be patient. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. Any opinions, news, research, analysis, prices, or other information offered by Grasping the Market is provided as general market commentary and does not constitute or replace investment advice. Grasping the Market accepts no liability for any loss or damage, including without limitation to any loss of profit which may arise directly or indirectly from the use or reliance on such information.